Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance, so you don't have to. And today we are diving into Capital One's latest report to see what is really bubbling beneath the surface of this financial giant. So what exactly is this report all about? Welcome to an 8K filing from Capital One Financial Corporation. This isn't a deep dive into every single number, but rather a peek behind the curtain at specific metrics. Think of it as a monthly checkup for the company's financial health. Now, usually these 8Ks are for significant events, but this one is using a specific item regulation FD disclosure to share some monthly charge off and delinquency data. Before we get to the juicy numbers, let's briefly look at what Capital One has registered with the SEC. They have common stock, as you'd expect trading on the New York Stock Exchange under the ticker COF. Then they have various series of preferred stock: Series I Series, J Series, K Series, L, and Series N also traded on the NYSE. Preferred stock is like a special kind of stock that usually pays a fixed dividend and has certain rights before common stockholders get anything in a bankruptcy. It is a way for companies to raise money without giving up as much control as issuing more common stock. They also have senior notes due 2029, which are basically big loans to the company, also listed on the NYSE with the ticker COF29. This just shows us the different ways Capital One is financing itself and the variety of investments people can have in the company. Now let's talk about the company itself. Capital One is a massive player in the financial world, primarily known for its credit card business, but it also offers banking and loan services. They are a huge institution, and their financial performance impacts a lot of people, from customers to investors. The main event here, this exhibit, is about monthly charge-off and delinquency metrics for December 2025. What does that mean? Let's break it down. Charge-off is when a company basically writes off a debt as uncollectible. For a credit card company, this means they are saying they do not expect to get the money back from a customer who has defaulted on their payments. Delinquency means a customer has missed a payment. So these two metrics are super important for understanding how well Capital One is managing its loan portfolio and how likely its customers are to pay back what they owe. Looking at the numbers specifically for December 2025, when we see entries like 927,628, followed by dates like the 22nd of January 2026, we are seeing internal identifiers and reporting dates. The important trend to watch in these filings is how these charge-off and delinquency rates change month over month and year over year. If offs are going up significantly, it suggests that more people are struggling to pay their debts. This could be due to economic headwinds like inflation, job losses, or simply people overextending themselves. For Capital One, a rising charge-off rate directly impacts their profitability because it means they are losing money on loans they thought they would collect. The list of different stock and debt types are essentially different sources of funding for Capital One, but the charge-off and delinquency data directly reflects the health of their core business, the actual loans they have made. For example, the Series N preferred stock member listing is just one of many ways they raise capital. But the delinquency of their credit card holders is a direct indicator of the quality of their assets. While this filing doesn't provide a comparative table from this particular snippet, we have to assume that Capital One is monitoring these figures very closely. Why is this so critical? Well, imagine you are lending money to friends. If more and more friends start telling you they can't pay you back, you start to worry about your own financial situation, right? Capital One is doing the same thing, but on a massive scale with millions of customers. A jump in delinquencies could signal problems in the broader economy or specific issues with how Capital One is managing its risk. It might mean they need to tighten their lending standards or set aside more money to cover potential losses. The date, the 22nd of January 2026, appears multiple times. This is likely the date the report was prepared or filed, which is shortly after the period it covers, the end of December 2025. This gives investors and analysts a relatively up-to-date snapshot of the company's performance. This filing doesn't give us raw percentages for charge-offs or delinquencies, but it implies that these very specific metrics related to their common stock. What we are looking for are trends. Are delinquencies rising? Are charge-offs increasing compared to last month? Or last year? If they are, this could mean a few things. First, the economy might be slowing down and people are finding it harder to make payments. Second, Capital One might have loosened its lending criteria to attract more customers and is now seeing the consequences. Or third, it could be a combination of both. A consistent rise in charge off rates over time would be a red flag for investors because it directly erodes profits. It is like a leaky faucet for the company's revenue. Now let's talk strategy. You see, companies like Capital One are constantly balancing risk and reward. They want to lend money to make money, but they don't want to lend to people who will absolutely not pay them back. So when they see these delinquency numbers tick up, they have to make choices. Do they try to work with customers to get them back on track, or do they cut their losses and write off the debt? The decisions they make now will affect their profitability for months and years to come. The existence of senior notes like the 1.650% senior notes due 2029 tells us that Capital One relies on debt financing as well as equity. The charge-off and delinquency rates are critical for the lenders of these notes too. If Capital One's loan portfolio is deteriorating, it makes it riskier for bondholders, which could lead to higher interest rates on future borrowings or even difficulty in raising funds. So it is a domino effect. So what is the overall picture from this peek into Capital One's operations? It is a reminder that even for large, stable companies like Capital One, things are constantly in motion. The financial world is dynamic and economic conditions can change quickly. This report, even without detailed tables, points to the importance of monitoring key performance indicators like charge-off and delinquency rates. They are the pulse of a lending institution. A steady or declining rate is like a healthy heartbeat, but a sharp upward trend can indicate an underlying problem that needs immediate attention. My take on this filing is that while it is not a full financial report, it is a crucial data point for a company heavily reliant on consumer credit. The fact that they are reporting these monthly metrics underscores their importance and the constant need for vigilance. We need to see the actual numbers and trends over several periods to draw firm conclusions. But this report tells us what Capital One is watching and what investors should be watching too. The strength of Capital One's loan book directly affects its ability to generate profits and maintain its market position against competitors like Discover Financial Services or American Express. Ultimately, Capital One's direction hinges on its ability to manage risk effectively in an ever-changing economic landscape. The key risks here are economic downturns leading to higher defaults and increased competition in the lending space. Opportunities lie in innovative product offerings and leveraging technology to improve customer service and risk management. The clear conclusion is that continued close monitoring of these charge-off and delinquency figures is essential for understanding Capital One's true financial health. Alright, that is our quick decode of this Capital One filing. What are your thoughts on these kinds of disclosures? Were they helpful? Let us know in the comments below. If you found this breakdown valuable, give it a thumbs up and subscribe for more straight talk on corporate finance. And don't forget to join our Discord community, linked in the description for even more insights and discussions. Thanks for watching Corporate Decoder, and we'll see you in the next video.